this video, I'm going to show you everything you need to know about forex trading. So you might be wondering, what is forex? The word forex is a mashup of the word foreign exchange, commonly used to refer to the foreign exchange market, which is the largest financial market in the world with a daily trading volume of over $6 trillion. Forex is a decentralized market with no single central authority or exchange that governs it all. It's made up of a network of banks, brokers, dealers, or even governments who trade currencies with each other: the dollar, the yen, the kiwi, euro, the Great British Pound, Canadian dollar, the Swiss franc, the Aussie dollar. What is a currency pair? Now, in forex, currencies are traded in pairs, because when you trade forex, you are buying one currency while selling another at the same time. Let's take a look at euro dollar. First currency in a pair is the base currency, while the second currency is the quote currency. Now, let's say you get a quote of Euro USD as 1.2344. This means that for every 1 euro, you get 1.2344 of US dollars. This is also referred to as the exchange rate. Therefore, when you buy a currency like euro dollar, you are expecting the euro to appreciate while the dollar depreciates. And when you sell euro dollar, you are expecting the euro to depreciate while the dollar appreciates. In forex, we have major pairs and minor pairs. All the major currency pairs include the US dollar, since the US is the world's largest economy. Therefore, these pairs are the most volatile and give decent moves on a daily basis. Some of the major currency pairs include the pound dollar, the euro dollar, dollar yen, dollar cad, dollar Swiss, Aussie dollar, kiwi dollar. We also have minor pairs and commodities like gold and oil. Let me take you through some of the basic terminologies used in forex trading. So the first one, what is a pip? A pip is the smallest increment of price movement a currency can make. For example, 1 pip for the euro dollar is equal to 0.0001. Most currencies are written to the fourth decimal place, with the fourth decimal place representing 1 pip. However, there are some exceptions when it comes to yen cross pairs, which are often quoted to 2 decimal places. A pip gain for the dollar yen, quoted 145.30, would be 145.31. In addition, 1/10 of a pip is called a pipette, which is represented by the fifth decimal place, as you can see in the example on the screen. The second term, spread. Spread is the difference between the sell quote and the buy quote, also known as the bid and ask prices. For example, if euro USD quotes read 1.3200 and 1.3203, the spread is the difference between the two, 1.3200 and 1.3203, which comes to 3 pips. Spread in this case is 3 pips. When you are looking to buy an asset on the forex market, you will pay the ask price for the base currency, and when selling an asset, you will sell at the bid price. The spread is essentially the cost you pay to enter the market. Now, different brokers offer different spreads that can change based on different market conditions. What is a lot size? In forex, positions are usually measured in lot sizes. Lot size can be divided into the following. The first one, we have a standard lot. Standard lot represents 100,000 units of the base currency. Then we have a mini lot. A mini lot is a tenth the size of the standard lot, which represents 10,000 units of the base currency. Then we have a micro lot, which is 1,000 units of the base currency. Then the last one, nano lot, which is 100 units of the base currency. Now you might be wondering how a beginner like you can access and trade the financial markets. Well, that's where brokers come in. Who is a broker? Now, brokers provide leverage, which is you borrowing capital from the broker to trade in much larger positions than the actual amount of money available in your trading account. You as an individual retail trader require a broker to access and trade the foreign exchange market. Brokers provide leverage that vary from broker to broker and are usually in ratios such as 1 to 30, 1 to 100, 1 to 500, to as high as 1 to 2,000. Bear in mind that with the high leverage comes high risk. Therefore, you can make high returns on your investment, but you can also lose as much. The higher the leverage, the higher the risk. Okay. Now, how do traders make money in the forex market? Well, there are different types of trading strategies, such as technical analysis. This involves studying historical price movements and data in order to identify similar patterns that have the possibility of repeating themselves in the future, since the market is frequently known to repeat itself. For example, in an uptrend, price tends to make higher highs and higher lows, just as shown in the example. Therefore, if you are a buyer, you would buy at a newly formed higher low, hoping for the older high to be violated and a new higher higher formed. The same apply to downtrends. You look at historical data and notice that every time price comes to this area of support, it bounces off. So you believe in the future, if price comes back to this area, there is a higher percentage chance that price will reverse off of it again, which represents trade opportunities. Another way traders trade the forex market is through fundamental analysis. Fundamental analysis is the study of how global economic news and other news events affect the financial markets. Example of major news events include the gross domestic product, trade balance, consumer price index, CPI, the non-farm payrolls, interest rate decisions, among others. Now, traders use this information to try and predict the upcoming market fluctuation in exchange rates and currency value and use them to their advantage. The economic events can be tracked using economic calendars such as MyFX Book, Forex Factory, Investing.com, among others. Now let's take a look at some of the tools you'll actually need in order to do your technical analysis and place your first trade in the forex market. The first one we can talk about is MetaTrader 4. MetaTrader 4 is mainly used for executing trades. We also have MetaTrader 5, which is the improved version of MetaTrader 4 since it has more features compared to MetaTrader 4. The next one is TradingView. TradingView is mainly used for doing analysis since it's more advanced with the more tools, so it can give you a better perspective of the market. So it's mainly used for, so you use TradingView to do your analysis, then you execute your trade using MetaTrader 4 and MetaTrader 5. I hope this was insightful. I wish you good luck and good trading.